Goodwill is the one line on a balance sheet that feels like a scam straight up until you actually understand what the hell it is. So let's get into it. So when a company buys another company, they never pay just the value of the buildings, the trucks, the computers, or the inventory. That stuff is easy to count. They pay for the intangibles, the invisible shit, brand power, customer loyalty, patents, software, reputation, a leadership team that actually works. You can't touch any of that, but it does move money. So Goodwill shows up when a company pays more than the fair value of the company they're buying. If the assets, say, are $200 million, but somebody pays $260, that extra $60 million, that's Goodwill. Goodwill basically says, yeah, we know what the math says, but this business is worth more than just the hardcover shit. But Goodwill is fragile. It only exists if the company keeps performing. If customers leave or the brand gets damaged, if management screws up, think Bud Light, accountants look at that number and go, yeah, this isn't worth what we thought, and they write it down, sometimes billions in a single quarter. But now let's compare Goodwill to the boring bookkeeping stuff. Depreciation and amortization, the slow drip of value disappearing. Here's kind of the simple version of it. Depreciation is for physical stuff wearing out. Buildings crack, cars break down, computers get slow, machines don't last forever. Accounting spreads the cost of those assets over the years you use them. You buy a $50,000 truck, you expect it to last 5 years, you depreciate 10 grand a year. So again, 50 grand, it's going to last 5 years. I'm going to take off 10 grand a year to reduce off my taxes. That's depreciation. Why do I do that? Because you didn't use the whole truck on day one. You use a little each year, so you expense a little bit of it each year. When I say expense, that means you're reducing your income because you're taking maybe a tax credit or a deduction for that amount. Now, amortization is the same idea, but for the invisible, intangible stuff. A patent lasts 10 years. Spread the cost over 10 years. Software that will be used for 4 years. Spread it over 4 years. If you can't touch it, but it still loses value over time, it gets amortized. So here's the real difference in English. Depreciation is for physical stuff going away, aging. Amortization is for intangible things expiring. Both are predictable, both happen gradually, both show up in the income statement the same way as a slow, steady expense. Now, Goodwill is special. Goodwill doesn't age. Goodwill doesn't get old. Goodwill doesn't fade. Goodwill doesn't depreciate. Goodwill doesn't amortize. It sits there at full value until one day it's suddenly not there. And then boom, the company takes its Goodwill impairment hit that wipes out billions instantly. No slow drip, just a cliff. So again, depreciation for physical stuff, amortization for non-physical stuff, and Goodwill just sits there until it's not there anymore. Let's freaking go.